On this video, I'm going to challenge the notion that the Japanese stock market has necessarily been an awful investment. So many people know that the Japanese stock market is pretty much the only developed world stock market which hasn't recovered from its height during the bubble. So the Japanese stock market, the Nikkei, hit a record of 38,000 in the late 1980s, and it went all the way down to 7,000. Now it's at a height it hasn't seen for 30 years, but it's still at about 27,000. So many people say, well, hold on a minute. This shows that it might be an outlier, but markets don't always recover because this one example is an exception to the rule. That, like in the US, there could be a crash in the Dow or the S&P 500, but it's always came back. But Japan shows there can be an outlier. Now, what is true is to say that the Japanese stock market has been one of the worst performing developed world stock markets. However, if you look at the calculator below and play around with it, you'll notice an incredible statistic. So the calculator below looks at the Japanese stock market performance from the 1950s, I think 1950, all the way through to January this year. And you can click the button to adjust for inflation and adjust for reinvesting dividends, because remember, all stock markets, just like the FTSE 100, S&P 500 and so on, they do pay out dividends every year, and that makes a huge difference. So let me give you an example of that. If you would have invested a one-off lump sum in the Japanese stock market pretty much any year since 1950, you would have actually made quite a decent profit. Even if you would have invested in the Japanese stock market right at the height, i.e. I think it was 1989 or whatever, and you didn't even add 1 penny more to the market, which is very unlikely, you would have only been down about 0.1% per year if you would have reinvested the dividends. And that calculator was made a few months ago or a few years ago or whatever, and it hasn't been updated for the fact that this year the Japanese stock market has done very well. So actually, somebody who would have invested right at the height of the Japanese stock market and always invested on the very unluckiest day possible and didn't add even 1 penny more would have been about even, assuming they reinvested the dividends every year. And of course, it's very unlikely that somebody would have done that. Now, what's interesting is if somebody would have invested in the Japanese stock market, the US stock market, and the bond market for the last 40 years every single month, actually the performance would have been relatively similar to if somebody would have just invested in the US stock market and a bond market index. And the reason is simple, that Japan was so low for so long that now it's came up again. Actually, the returns haven't been too bad. And as you'll be able to see from the calculator as well, if you look from a very long-term perspective, the Japanese market did very well. In other words, from the 1950s until now, it's done very well. If you look at a short and medium term perspective, i.e. since 2008, surprisingly, the Japanese stock market's done very well. So it's only done badly if you would have invested right at the top and you didn't reinvest dividends and you didn't invest during the down times, which happened during the 90s and the early to mid 2000s. And also you didn't do all the things that you should do if investing, i.e. have diversification, be in different investments and so on. So in a way, the Japanese market has not been as bad as people actually assume. The only people who would have actually lost in the Japanese stock market are those who would have bought near the top and they panic sold and they didn't reinvest dividends, and they also didn't invest in international stocks and indeed a bond index. So the sensible investors who got into Japan kept their money there long term and they had a diversified portfolio. But beyond that, it shows something very important about investing, and that's that dividends really matter. I mean, I'm going to be doing another video on the Dow Jones hitting 30,000, but what's interesting is the media don't report on dividends. They don't say, oh, breaking news, the Dow's hit 30,000. Oh, and by the way, if you would have reinvested your dividends in the last year, you would have been up even more. They don't report it like that, of course. So if you look at a chart of the Nikkei, you'll notice, yes, it hit 38,000. and now it's at 27,000. But of course, that's not adjusting for the dividends. So over a long period of time, that makes a huge difference. And even markets that have gone up over time, which is pretty much all the other main developed markets, if you actually adjust for dividends, it makes an absolutely huge difference. So even the S&P 500, about 35% of its historical returns are linked to dividends. So to give you some statistics, if you would have invested in the S&P 500 since 1950, you would have gotten about 7% after inflation, which is about 11% per year or so before inflation. I'll also put the graph below for the S&P 500 index. But if you wouldn't have reinvested the dividends, I think you would have only got about 4.something%. So it makes a huge difference. And we've seen that recently with the UK stock market as well. The UK FTSE, it did hit a record high in 2018, but the FTSE has one of the best dividend yields in the world. So somebody who would have reinvested dividends from the FTSE 100 would have actually done much better than people think as well. And as a final comment, I would say that, of course, nobody knows what's going to happen with the Japanese stock market for sure, but I do actually think that it will fully recover, and we will see it one day hitting record highs both in nominal and real terms, but we'll have to see about that.